Have you ever wondered whether the money in your wallet actually existed physically before you got it? Think about it. A dollar, pound, or euro you use every day might have been created with just a keystroke. And this isn't imagination, it's real. To understand, let's go back to a time when humans only bartered goods, grain for tools, or livestock for cloth. But barter was inefficient. Trust between people was always a problem. Then came coins, invented around 600 BC in Lydia, and later, the concept of banks during Renaissance Italy. Families like the Medici didn't just store gold, they lent it out and earned interest. And in doing so, they discovered something profound. Not all money they lent needed to physically exist. If one account had a deposit, it could fund a loan elsewhere. This was the birth of fractional reserve banking, where banks keep only a small fraction of deposits and let the rest circulate. The real transformation of modern banking came in the 20th century. When the gold standard was abandoned and fiat currency was introduced, money whose value is not tied to gold, but to government decree, suddenly banks had the power to create digital money. With just a keystroke when issuing loans, imagine this: if you take out a mortgage for $300,000, the bank isn't giving you someone else's money, simply crediting your account with $300,000 that didn't exist before. This is how modern money is created on. It's all debt-driven. Figures like Paul Volcker and economists like Hyman Minsky shaped this system and warned that too much credit could push an economy to collapse. At first, the system worked brilliantly. Economies grew, people's assets increased, but debt levels also climbed to dangerous heights. Then came the breaking point, the 2008 global financial crisis. Banks had created trillions of dollars in loans, bundled into mortgage-backed securities and complex derivatives. When housing prices fell, many loans went bad, and the digital money the economy relied on disappeared. Governments had to bail out banks. People lost homes, savings, jobs, and stock markets crashed. This made one thing clear: creating money is not magic. It's a powerful tool that, if mismanaged, can trigger disaster. After 2008, central banks turned to quantitative easing. Trillions were injected into the system to stabilize the economy. Markets recovered. But inequality soared and asset bubbles expanded, and the cycle continues today. Modern banks keep creating credit, sometimes linked to real economic growth, sometimes disconnected. The numbers are staggering. In the United States, banks create 97% of the money supply. Only 3% exists as physical currency. Globally, total debt has surpassed $300 trillion. Over 350% of world GDP. Every dollar created is a bet on the future. And if confidence falters, the fallout could be worldwide. So, what can we learn from this story? 3 key takeaways. First, money is mostly a promise, not a physical asset. Second, debt drives money creation, and risk is always present. Third, history repeats itself. If warnings are ignored, from medieval Italy to modern financial crises, the cycle of credit expansion and collapse continues. Understanding this is crucial if we want to make smarter financial decisions. Ultimately, the power to create money is one of humanity's greatest financial innovations, but it also comes with immense responsibility. The next time you check your bank balance, remember most of that money didn't exist yesterday, and in the future, it may only exist as a digital promise. If you found this story fascinating, like, subscribe, and turn on notifications, because we're just beginning to uncover the invisible systems that shape our daily lives.